All right, good morning everyone. Bruce Beddard with Beddard Mortgage Team here. I am recording this installment of my update on February 26, 2011. If you need to get in touch with me, please don't hesitate to call me on my cell at 847-772-1780. Now, global issues are still contributing to what's going on in the markets, and particularly what's going on in Libya. The fear of oil disruption was the one thing that I told you that we needed to be concerned with. The past 10 days, we've seen oil risen, the barrel of oil rise from $88 a barrel to over $100 a barrel in intraday trading. Now, on Friday, that moved back a little bit as Egypt announced that they would pick up any slack from the shortages that Libya might be having. Now, reports this morning suggest that rebels have taken over the oil field, all of the remaining oil fields in Libya, and in essence, all of the oil production, which I think is 12% of the world market, has in fact been cut off. So, in a case like that, why should we care? Well, fear has caused, anytime there's a fear in the world market, that causes what we call a flight to safety, and the greatest safe haven is U.S. Treasuries. And why do we care about U.S. Treasuries? Because as more people pile money into U.S. Treasuries in order to be safe, then that drives up the price and lowers the interest rates. And in fact, that's what we've seen. We've seen 10-year bond rates, which just 10 or 12 days ago were at 3.77%. Now this week down to 3.44%. And so that trend will likely remain in force unless or until there's some kind of certainty brought to the forefront in the Middle East unrest. And I don't anticipate that's going to happen in the next couple of days, because even if there was an overthrow in Libya, that isn't going to settle things down anytime soon. We're still going to have turmoil for at least a few more days. Now, mortgage rates are at a pivotal point. We see interest rates are still at 4.875% on a 30-year fixed-rate mortgage. And again, I quote that with 0 points. That's where we were last week, I believe, at this time. And that isn't unusual that we see the same rate. That's not a big deal to me. What is unusual, though, is at this level, at the 4.875 rate, we see what I characterize things as a cliff. And what I mean by that is there's a normal price that we pay someone, a loan originator like myself, to originate a loan at 4.875 on a 30-year fixed. And we're at that rate where most people would look at that interest rate and say, that's the rate I want to offer someone. Well, normally 4.75 will pay us a little bit less, and 4.625 will pay us even a little bit less. But generally there's a trend, as the rate goes lower, it pays us a little bit less. And in fact, what we see right now is that there is a cliff. 4.875 is here, and 4.75 is here, paying us virtually nothing. It's almost as if the banks are saying they don't trust that 4.75 will be here for more than a few days or a few weeks, if at all. And so therefore they're suggesting that we just not price a loan at 4.75. They're making it nearly impossible by paying us virtually nothing. It's almost like right after the mortgage crisis started, we saw banks that were offering adjustable rate mortgages at the same price, and in some cases higher prices than 30-year fixed rate mortgages. So of course, why would we recommend to somebody to get an adjustable rate mortgage when in fact the rates were higher or the same price as a 30-year fixed? It just wouldn't make sense. They were pricing the loan so that we would not sell an adjustable rate mortgage. Right now, they're pricing the loans as if they're saying, I don't want you to lock a loan at 4.75. The only reason they would do that is if they just believe that 4.75 isn't going to be there for very long, and so they just don't want to take that risk. Now, what's going on locally here? The housing data was mixed again this week. Existing home sales were at 5.36 million, with an expectation of 5.23 million, so better than expected. New home sales were at 284,000 versus the expectation of 310,000. So while that number was lower, the previous month was very, very high, and nobody had expected it to be that high. So who knows whether that's just going to even out or whether we're going to see another low trend again as we move into January's number next month. Now, new home inventory, though, is a pretty It's a pretty good piece of data that I think we should talk about, and that is that new home inventory across the entire nation is at 188,000 units. That's the lowest level of new home inventory since December of 1967. I think that's a piece of data that's a story that's there. Now, granted, the number of homes that are new homes that are selling is very, very small, so we still need that number to go lower. But that's a good telling point that we're back to new home inventory that we haven't seen since 1967. Now, consumer confidence remains high, but we need to watch that consumer confidence as gas prices continue to go up in the upcoming weeks. My opinion, if we hit $4 gas here in the Midwest, and we're really close to that already in California, but if we hit it here in the Midwest, then I think the consumer sentiment could really start changing. We're concerned right now because we're already seeing fuel surcharges being increased in the airline industry. I think UPS announced that they're going to increase their fuel surcharge. Taxi drivers in the city of Chicago increased their fuel surcharge this week. So there's a concern if that spreads, if that's widespread, because you guys know what happens. If that goes out and hits the market, it takes a long time for it to go away. So we're just hoping that the fuel prices stay in control and a barrel of oil will come back down so that we don't see that get out of control. Now, initial jobless claims were at 391,000 this week. The 4-week moving average, which is the number that most of us really like to keep an eye on, was at 402,000. Again, another statistic. We haven't seen that level, 402,000 on the 4-week moving average, since 2008. So again, another piece of data that looks pretty good, but again, we got to keep monitoring it. Now, next week, what do we got coming up? Unemployment is reported. Initial jobless claims, the 4-week moving average could drop below 400,000, and I've got to find out exactly when the last time was we had the 4-week moving average below 400,000, but it's been a long, long time. Factory orders are due out next week. We want to see if the higher fuel prices have any impact on that number already. It likely won't, but we'll see. If that number does not look good, that could really be some pretty ugly information in terms of what could happen to job growth moving forward. Now, the 5-day trend for mortgage rates suggests that we might see flat to slightly lower rates. Now, if we see 4.75, as I was describing that cliff to you, if we do see 4.75 this week, I suggest locking and loading. We should not let that slip away from us. So if you have clients that are on the fence and they see 4.75 with 0 points, take it and run. Now, if you know of if you're a top-notch real estate professional, if you know a top-notch insurance, financial planner, estate attorney, divorce attorney, or BK attorney, if you know a builder, if you are a builder, I'd love to speak with them. Especially need a credit expert. They will do well on the radio show with me. Remember, I'm here to assist you in any way that you feel will benefit you and your business. Just give me a call at 847-772-1780, and I will make myself available to you. Give me a call. I want to help you make a difference in your business. I hope you have a safe and prosperous weekend. We're going to take back this real estate market one transaction at a time. You and me. Bruce Beddard with Beddard Mortgage Team.